As a lender, the main reason why you're going to be looking at house hacking or buying this home as an owner-occupant as opposed to buying a rental property that you don't live in.
And 3, 2, 1. And hello everybody, welcome to Hello Haymarket. This is going to be episode 8, and with me today I have a returning guest, Mr. Coleman Bales. Coleman, for those of you who don't know, Coleman was on an earlier episode with us, and I wanted to bring him back because today we have a really exciting topic. Those of you who saw some of our recent episodes, we talked about house hacking, and we talked about one of the key value propositions of house hacking is the advantages of other people's money and being able to take advantage of the owner-occupant type loans that you can use when you're doing a house hack. So who better to talk to than Mr. Bales?
Absolutely. Thank you for the intro, Dan. And it's great to be back on the podcast. So for those of you that didn't see the first episode, or if this is your first time watching, my name is Coleman Bales. I work for McLean Mortgage. We're an independently owned mortgage company here in Northern Virginia. I'm the preferred lender for Dan and the rest of the Kaza group that he is a part of. And this is really a great topic. I'm really excited for today's episode because Dan and a lot of the other agents on the Kaza group are really experts on working with folks that are investor minded or are looking at even if they're buying a home as their primary residence for themselves. It's it's the biggest purchase of your life, and so it makes sense to look at it like an investment. And yeah, that's pretty much what we're going to be talking about today a little bit.
Yeah, 100%. I mean, the tagline for our show is that we like to help people build wealth through real estate, and this is where it starts for most people. Right? This is the beginning. Whether you're doing a house hack or whether you're just buying a starter home that you're eventually going to graduate from, being able to take advantage of these kinds of owner-occupant loans is going to really accelerate your progress from wherever you happen to be starting to the financial freedom goal that you're setting for yourself. So, Coleman, let's dig into it. What I'm going to do today is I'm going to hit you with 5 different scenarios,
okay?
Right? Because there's a lot of options, a lot of different loan programs that I've seen different clients use, and knowing which one is right for them can sometimes be a process that requires the help of a lender.
Absolutely.
So since you're a lender, let's get your help on these.
All right. Let's do it.
Scenario number 1. What might you recommend for someone who is a first-time home buyer? Where would you begin with them?
Absolutely. So it's going to be an it depends answer. As a lender, the way that I look about it, the main reason why you're going to be looking at house hacking or buying this home as an owner-occupant as opposed to buying a rental property that you don't live in is really just, it's mainly because of the loan products. So you're going to get a whole lot better interest rate on your loan if you're buying it as a primary residence than as it would be as an investment property. You're going to be able to put less money down. So your out-of-pocket expenses are going to be less. Your interest rate is going to be less. As a primary residence, you can write off the interest on your taxes. So there's a variety of different reasons why it's a superior financing option if you really plan to live in it as your primary. And it's repeatable. So if you want to buy something as your primary, rent it out. After a year of living there, you're eligible to buy another primary residence. You can move out of that property. Now it's a fully functioning rental property that you don't live in, and you can go buy your next one and rinse, repeat. You can keep doing this over and over. So back to your question of what loan makes most sense for the person buying their first home. Mm-hmm. I would say as a generality for the majority of people, conventional loans are going to make the most sense. You hear a lot of people throw out the FHA loan option for folks in this kind of space of the internet. If it's your first time buying a home, sometimes it can be easier to qualify for an FHA loan. But if you have great credit, more than likely you'll probably want a conventional loan. The reason for that, there's a couple different reasons. To me, it mostly comes down to what's called mortgage insurance, which is not an insurance policy on if the home burns down. It's a mortgage insurance. Mortgage insurance is a policy for the bank, so it's really a fee that you're paying. And FHA loans, they require that to be paid on a monthly basis. They also charge an upfront mortgage insurance premium, so you're paying upfront and monthly, whereas a conventional loan, they don't require that upfront mortgage insurance premium. You can do it monthly. You could do it upfront and not have it monthly, but either way, the mortgage insurance piece is going to make a conventional loan cheaper for you than an FHA loan, assuming that your credit is above about a 680. Maybe some folks might even say 660. So as far as the down payments go, some people think, okay, FHA makes the most sense because I can get away with only 3.5% down. Well, as a first-time home buyer, if you were to look at a conventional loan, you can actually, in most cases, do 3% down, which is even less. Talking again about the mortgage insurance piece, on a conventional loan, if you put 20% down, no mortgage insurance whatsoever. FHA's, you're pretty much stuck with the mortgage insurance unless you put more than. You can get rid of it in some circumstances with a substantial down payment. But with any conventional loan, once you pay the loan down to 80% of what you bought the home for, you can just completely eliminate the monthly mortgage insurance that you would be paying. So FHA would stick with it the whole life of the loan. So going back to it, as a rough generality, conventional loans are really just going to make the most sense for you. Cheaper interest rate, cheaper mortgage insurance, less out of pocket. It's a home run.
And something else you mentioned was that it's repeatable, right?
It is.
So the conventional loan type is got that flexibility to it, where if you are the first-time home buyer, there's certain advantages. Like you mentioned, you can have even less out-of-pocket up front, 3% instead of 3.5% with the FHA. But also it's repeatable when you decide to graduate onto your second or third or fourth property. So with your permission, I'd actually like to bring you in on this on your own current purchase that you're under contract for. One of the reasons I wanted to bring Coleman on today is because he walks the talk. He is actually engaging in a house hack deal at the moment. He's in escrow for his purchase, and I think I actually like to hand it off to you. What kind of loan type are you using, and give us the basics of the deal.
Absolutely. So just to give you the rough general, I am part of that vast majority of people that a conventional loan made the most sense for me. We are under contract to purchase it. If you guys have listened to the episode with Thomas Price, I think he was on the podcast recently. It's I know Thomas and myself are good friends, and very similar deal to the one that he laid out. So townhome here in Reston, Virginia. It's 3 levels. I'm going to be living in the basement. Basement has like a suite kind of. The middle floor is your living room, kitchen, hangout spots, and then upstairs I'm going to have 3 bedrooms, and I'm going to fill them with 3 of my buddies, and they're going to be helping pay my mortgage each month. So
it's a good deal for everyone involved.
It's great, and I will be. Some people think about house hacking, like the term came to be, is it's a hack, in that you can get your roommates to pay all of your mortgage. It's like a free house, basically. You pay your down payment or whatever. Mine's not quite that, in that our local market is priced such that as like $1 of value, the amount of rent that you get per $1 of value is lower in Northern Virginia than it is in a lot of other parts of the country. So if you're in a more rural area, not as when you get closer to these cities, the prices are higher per $1 of value. So it's harder to make cash flow work. So I am still not. They're not going to cover all of my mortgage. So I don't know if you call it a true house hack or not.
Oh, it is.
But it's still going to be cheaper than renting.
Here's why I would say it is, because all 4 people involved are coming out ahead. Mm-hmm. They want to live in an area where housing costs are incredibly expensive and inflated. Yeah. And in order for that to happen, you either need to be uber rich or you need to work together.
Right.
And so they are now offsetting your housing cost, which allows you to now take that money that you would have spent on the housing, and you can spend it on either other investments or you can spend it on lifestyle.
Absolutely.
And so that completely changes the calculus for the decisions you make when you're purchasing real estate in an area like this.
Yeah, I would agree. I would totally agree. I mean, people are like, rates are going up. People are scared about rates and this and the other. And it's not exactly true, but you can almost think of rent as having 100% interest rate. It's like your entire rent is an expense that you're never getting back each month.
Yeah.
And in this situation, even though my roommates aren't covering 100% of my payment, they're covering enough to where that difference that I'm paying, my mortgage minus what their rent is, it's still less than if I were to just get a lease and live around here. So it's cheaper monthly. It's an asset that's going up in value over time. It's appreciating. Mm-hmm. I'm claiming depreciation on my taxes. Mm-hmm. So there's tax benefits. I'm writing off money from my tax liability, and I'm writing off the interest as well. Yes, there's interest, but I'm writing off of my taxes.
Yeah.
So there's a myriad of benefits that I'm getting out of it that would vast superior than paying rent.
Yeah. And for those of you who are out there listening and all of this sounds really exciting to you, definitely go back and rewatch the other 2 episodes that we did. The House Hacking 101 episode that kind of goes over a very high level what this process is for with Mike Weber, and then the case study that we did with Thomas Price. But so kind of circling us back here to why you went with conventional. Why did conventional make the most sense for your house hack?
Yeah, absolutely. So it really just came down to that, I'm not going to say what my credit score is, but it is at a point where I qualified for a conventional loan. And for those people that do qualify for a conventional loan, it really, like I said earlier, it typically makes more sense than FHA. If I was someone where an FHA loan was the only shot that I could qualify for, I would still be buying the home with an FHA loan. But since I qualify for conventional, it's going to be cheaper for me because of that mortgage insurance that I spoke about to do so.
And that matters because at the end of the day, this is a financial decision we're making. The whole point of the house hack is to help move you forward in your financial life. So anything that you can do that gives you the better deal, that gets you from where you are to where you're going a little bit quicker, that is valuable information.
Absolutely.
So let me hit you with a different scenario now.
Okay.
All right. So you mentioned that you have some decent credit. What if your credit is a little subpar, right? So for those of you who are struggling with credit, where would you have them look?
Absolutely. So that's where FHA loans really do start to make more sense. So as I kind of alluded to, even if I didn't qualify for the conventional loan, I would still be wanting to buy this property as an FHA loan. With an FHA loan, excuse me. Why is that? Is because one, you still get the benefits. You still get the home going up in value, still depreciating it, writing off your taxes, writing off the interest in the meantime. Rents will continue going up, and so over time, I may get to a point where my tenants pay all of my mortgage, even whether I'm living there or not. And so for someone that's still working on their credit, you would be better off to buy a home with an FHA loan now than you would to say, oh, I'm going to wait till I get my credit score up and then buy it with a conventional, because one thing is that even if you buy it with an FHA loan, and if interest rates come down in the next couple of years, assuming that they do, because more than likely at some point they will, then you can refinance an FHA loan into a conventional loan and get rid of that mortgage insurance that you thought you were going to be stuck with.
Yeah. And that's something I've actually seen clients do, where they're working on their credit, they want to get started in the game, they don't want to wait, they want to take action, they understand that time in the market is more valuable than timing the market.
Absolutely.
Right? They
That's
understand
huge.
that the sooner they get on the side of the table that is winning, the better.
Right.
And so that's where I think, if I'm understanding you correctly, an FHA loan can be truly valuable because it helps you get in the game sooner, which means a year from now, 2 years from now, yes, you can improve your position, but because you got started, now you're already ahead.
Right. If you're to wait, you're going to be in a spot where more than likely prices are going to also be going up, and so you'll find yourself in the future paying more for the same property that you could have had a year ago with an FHA loan.
We've definitely seen that in the last year or two.
Yeah,
I had a
for sure.
client who wanted to buy a year or two ago, and they kept waiting. Oh, there's going to be a crash. Oh, there's going to be a crash. Well, they finally ended up buying, but they just paid an extra $100,000 for the home because the market was taking off wildly and it never crashed.
Exactly.
So
let me go over one more thing before we move on from FHA loans. There is a specific situation that while this is Hello Haymarket, we're talking about a local area. The reason why I didn't bring it up earlier is because we're in Northern Virginia and they don't really have a lot of these properties available around here. But if there's any folks around here that are watching from another area of the country, or just happen to be in a market where they see these type of properties available, some folks will use an FHA loan even if they have great credit, simply because they want to buy a multi-unit property and want to minimize their out-of-pocket expense. So let me slow that back down a little bit.
Yeah,
so I talked
explain
about
that to us.
So I mentioned earlier, a conventional loan as a first-time home buyer, you can put 3% down. That's as a first-time home buyer. Repeat home buyers, most of the time, are putting 5% down. Most of the time, at least. There's caveats to a lot of these things, but if you want to buy a 2-unit, a 3-unit, or a 4-unit property with a conventional loan, you're going to need more for your down payment. So 1 unit, 3 or 5% down. 2-unit, 15% down at a minimum for a conventional loan. 3 or 4 unit, 25% of down. That can be a lot of money when you're considering whatever purchase price you're looking at. It's a lot more money to bring to the table. And yes, the rates are going to be better than FHA. Yes, the mortgage insurance is still cheaper. But with an FHA loan, in this specific situation of a 2 through 4 unit property, some people still use it because you can still use 3.5% down, regardless of 1, 2, 3, 4 units.
Yeah.
3.5% down, you can save, just
That's really valuable information. So just to recap that, and correct me if I'm wrong with any of my my rephrasing. I was just talking to one of my clients actually recently. Met him maybe a week or two ago, and he wants to buy multifamily, which again means 2, 3, or 4 unit.
Yep.
Right. And one of the questions he asked me that he wanted to know was, well, how much money do I have to get for my down payment to actually make this happen?
Yep.
Right? Because the whole point of buying multifamily is that you are trying to improve your financial position.
Right.
Right? You're trying to offset your housing costs by renting out the other units. Right? If it's a duplex, you rent out one of them. If it's a quadplex, you can rent out 3 of them.
Right.
Right?
Oh,
and live in the 4th. And the calculus changes tremendously if you need 25% down compared to if you only need 3.5% down, right? For a lot of people who are looking at this as a solution to their financial problems, usually if you have quote unquote financial problems, you also are not sitting on a pile of money.
Right.
For most people.
Right. Yeah.
Right? Well, let's move on to our third thing here. Third situation. Are you ready?
Let's do it.
Third situation is going to be, what would you recommend for a veteran?
Absolutely. So for veterans, VA loans are really just the cream of the crop for just advantageous loan terms. 0% down, you're going to get the lowest interest rates out of FHA, conventional, VA, even jumbo loans. Like VA loans, with hands down, are going to get the best interest rates. Mortgage insurance, you just don't have it. You don't have to worry about upfront mortgage insurance. You don't have to worry about monthly mortgage insurance. The only thing you have to worry about is a guarantee fee, or funding fee, excuse me. Which can be substantial. If it's your first time, it's typically like 2.3% of the purchase price is charged in this funding fee, which is similar. It's kind of similar to mortgage insurance, like if you're comparing it. But that gets financed into the loan amount, so you don't actually pay it out of pocket. And if you're a disabled military veteran, you don't have to worry about the funding fee. So if you're a military veteran and you're looking to buy a home, I just 100% go.
Yeah, that's where you start.
There's not a whole lot of drawbacks really.
All right. So the key benefits then to the VA loan was better rates.
Yep.
0 down.
Yep. No mortgage insurance.
And by the way, as an aside, I have definitely had VA clients, who I remember the first time I ever had a VA client close a deal, and they were handed a check instead of handing a check to the seller. They were handed a check because of the way it worked out, where it all kind of got rolled into the loan. And normally you need to be the one bringing some money to the settlement table on closing day, where you're either paying for down payment, paying for closing costs, etc. But there is a way to structure those VA deals where you actually end up with, so little out of pocket that they're the one handing you a little bit of money. Exactly.
Or they could literally, if you do 0% down, and with VA loans you can get a max of 4% seller credit.
Yeah,
so
that's a lot.
4% of the loan. Usually your closing costs are more like 3, sometimes even a little bit less. So there's extra money to be had. If you ask for that full 4% and you've got like credit card debt or consumer loans, you can literally take the leftover and have your loans paid down, your credit cards. Like the seller can literally pay you to buy their house.
Yeah. It's crazy.
Yeah,
it's crazy.
Great.
They deserve it though, right?
They do.
We're supporters.
Absolutely.
All right. Next situation. You mentioned rural. So what about that? What if we have someone who's interested in looking in a rural area?
Sure. Okay. So USDA loans can be a great option for the people that it's a great option for, but that percentage of the percentage of people that actually it makes sense for is lower than you might expect. And I say that because USDA loans, let me just first of all say that they're a great program. Similarly to VA loans, you can do 100% financing. There's no actual mortgage insurance to them. They have great interest rates as well. They're great loans all the way around. They're just much tougher to qualify for. So the biggest thing is they have income limits. And it depends on where you are in the country and what the median income is for wherever you live. But the USDA, they're going to set limits to how much money you can make. And it's not just you, it's actually the whole household. So everyone that's moving in, you're going to be collecting your W-2s and stuff from your spouse, and in some cases even your children. Like, even if they're not going to be on the loan, you have to consider that. If the whole household income exceeds those limits, like, you just can't use an USDA loan.
Mm-hmm.
So that's a problem. And the other thing is that you also have to have very good credit for USDA. Like like you have to be in the 700s for sure, like mid 700s probably. Low 700s maybe you can get away with sometimes, but so you have to have great credit. Your income has to fall below these limits, and you can't have a whole lot of extra debt with credit cards, auto loans, things like that. Just because of the fact that with the income being below these limits, if there's much other debt, we're just not going to be able to qualify you for we may not be able to qualify you for enough to where you can find a home in your market that you would be happy with living in.
Yeah, so a lot of stipulations there.
Yeah. Mm-hmm.
But if I heard you right, you said so good credit, very little debt.
Right.
Your income has to be low enough, and those two things are related, right?
Right.
Because we're looking at the debt to income ratio.
Yep.
Right?
Yep.
So we're looking at both of those. So what I'm almost imagining is maybe someone who's kind of young getting started, they don't have a ton of money rolling in from a well-developed career yet. And I know most young people, they love to either go to a college town or they love to go to like a city. But if you're willing to look in a rural area, right, pull up the map online and see what areas are actually eligible.
Yep.
And as long as they have built up good credit, this could be a zero down easy way to get in.
Absolutely. The map thing is big. Like, I'm glad that you brought that up, because USDA loans, they're rural housing loans. They're meant for folks in rural areas. So yes, if you're interested in a USDA loan, look up the map. There's specific identified areas where you can use USDA loans. There's a lot of places where you can't, and it's meant, cities, places with lots of people, you're not going to be able to get a
generally
USDA loan.
speaking, the more people there are, the less
You're
the less likely you're going to find something there. Now, I've heard of these things called opportunity zones. If you have someone who's interested in going after one of those zones, is there like a special loan type, or like how does that work?
Yeah.
What's attractive about that?
So, so the government has identified opportunity zones. There's various, there's a map for it, same way that there's a map for USDA eligible properties, and they've identified, areas where maybe it's lower income parts of town. Oftentimes you can buy, and there'll be tax benefits to them. A lot of investors will buy them because you can buy them and you can get rid of having to pay capital gains tax if you buy it and improve it a significant amount, hold it for like 10 years, and you can sell it and avoid capital gains taxes. Some sophisticated investors will use it for that reason. In the context of the whole house hacking conversation, I would say there are advantages for folks that are not that level yet. One of which would be that you can use a VHDA loan to buy property in an opportunity zone, whether or not you're a first-time home buyer. So I'll back up and say, what is USDA VHDA in Virginia? It's Virginia Housing. It's the state-run down payment assistance programs, and so it's, like I said, it's typically for first-time home buyers. And each state has different programs for down payment assistance for the most part. In Virginia, it's just called VHDA. Or Virginia Housing is what they changed their name to. We still always call them VHDA. So they will offer grants for your down payment. Like, you can, with a conventional loan, they will offer a 2% grant out of your 3% down payment. There's another program where for VA or USDA folks, they can get a 2% grant for, they don't have a down payment, so they'll use them for the closing costs. It's a closing cost grant. A few other niche products, if you wanted 100% financing, they have second loans that will cover your down payment. I typically recommend the grant program over that, but each person, each situation is different. Tying this back to the opportunity zone thing is that, if you've bought a home already, you're not a first-time home buyer anymore, but you're looking at something in an opportunity zone, you could still use a VHDA loan in an opportunity zone to buy another property, even if you're not a first-time home buyer. So that way, you're looking at, I said, a 3% down. You could get a 2% grant. That's seriously reducing your out-of-pocket expenses.
Yeah.
And if it's a VHDA or a VA loan, it could cover almost all of your out-of-pocket expenses, because then you're just looking at down payment, or closing costs.
Gotcha. So is the grant separable from the loan type?
It's through VHDA. So, I mean, the loan type, VHDA has conventional loans, FHA loans, VA loans, and USDA loans, but you can pair their grant program with each of the different programs, basically.
Gotcha. So you could potentially, if it's in an opportunity zone, you could use a USDA loan with a 2% grant?
Correct. Yep. Even if you're not even a first-time home buyer, you could do that.
What would happen if the realtor was able to also negotiate closing costs to be paid, like a seller subsidy?
Yeah, you do have to be careful because there are interested party contribution limits, with each different program. Like typically, even if you're, like for a conventional loan, it's typically 3%. It can be more if you put a larger down payment, but 3% for conventional, 4% for VA loan,
Gotcha.
Or FHA can be like 6%.
Wow.
You can get significant. So so if you the grant is specifically for your closing costs or down payment, and so if you have too large of a credit, you could run into issues where
so there's always limits.
You could still use it to buy down your rate, I suppose, if you were interested in that.
Gotcha.
Yeah,
that way
an
your
option.
Payment gets lowered.
Sure.
Yeah.
Yeah. So if you run out of closing costs, it's a good problem to have. If you run out of closing costs, then you can use it the leftover to buy down your interest rate further.
So essentially, what we're looking at is the key benefit of an opportunity zone is that besides the tax benefit and the capital gains, if you hold it long enough,
right?
And I think that's generally what people are looking for. They're looking for advice on how to begin the journey, so that way 5 years from now, 10 years from now, they'll look back and say, I made the right move, right? So if you were to look into an opportunity zone and you were to get this 2% grant, that's free money, by the way. 2%. Yeah, that's cash
serious,
up front, right?
Yeah.
That's not nothing.
You don't have to pay it back.
Yeah. Especially out here in Northern Virginia, where houses, like a starter house is like $300,000.
Yep.
It's like 2% of that is $6
grand.
Yeah. That's some serious money. And then if on top of that, down the road, you can sell that and forego the capital gains. Right, those of you who don't know, capital gains, that's Uncle Sam here to eat your lunch money, right? Depending on the situation, that can be a serious chunk. So being able to avoid that it can be a really key benefit as well.
Absolutely.
You mentioned some other tax benefit. What was that?
It was mostly the capital gains tax with opportunity zones, really. And you don't, I would recommend if you're looking into the tax plays to contact your local CPA. I'm not an accountant. I don't want to pretend like I'm the tax guy at all, because I'm really not. But I know that if you buy something and put improvements, like if you put as much money into the property as you paid for it and keep it for 10 years, you can get rid of capital gains tax. If you buy in an opportunity zone and just hold it for a couple of years, there's smaller tax benefits that you can get. But again, I'm not a tax guy. I don't want to pretend like I'm a professional there.
We'll have to get somebody on.
Yeah, next episode, we're getting a CPA.
Okay, so we've got 5 different scenarios, running through them really quickly. First-time home buyer, conventional.
More than likely.
Someone with less than stellar credit.
FHA.
Check FHA.
Or if you're buying a 2 to 4 unit.
Or, for multifamily, FHA.
Potentially, yep.
Veteran.
VA, all day long.
Rural buyer.
Potentially USDA if you're eligible.
Yep. And then opportunity zones. What do we look for?
Yeah, I would still say with an opportunity zone that, regardless of the loan product, they've got significant advantageous benefits. But if you're someone who really likes the state bond, like the VHDA down payment assistance programs, and you're not a first-time home buyer, you might consider an opportunity zone just because of the fact that you could use a VHDA loan again.
Yeah. Okay. Coleman, this has been great.
Absolutely, Dan. Thanks for having me on.
Let's tell the folks out there how they can get in touch with you, so that way you can help navigate for them, right? Because every situation is unique, right?
Absolutely.
These 5 give us some expanded knowledge, but it's nothing close to what you have in your head.
Sure.
So how can the folks get in touch with you?
Absolutely. So if you're someone that is interested in maybe buying your first home, maybe doing a house hack, and wants to see the difference in how your net worth is going to be affected as compared to if you were to keep renting, I'm happy to put something like that together for you. If you want to just have a conversation, I'm happy to do that. If you are ready to go ahead and apply, I would go to colemanbales.com. That's COLEMANBALES.com. And once you apply for a mortgage there, I'll immediately reach out to you, and we're going to be going over all of this stuff together. If you're not ready for that yet, and like I said, you just want to have a conversation or might want to have that rent versus buy scenario put together. So I would say to email me, and then I will reach out to set up a consultation. And you can email me at cbales, CBALES, at McLeanMortgage.com, and we'll get something set up for you guys.
Okay.
Let's do it.
All right.
Sure.
Well, Coleman, thanks again for coming in today.
Absolutely.
I
Real
appreciate
pleasure.
you. All right. Bye, guys.